Okay, I need to tell you about something I've been doing with buyers that sounds completely made up. I've been telling people to pay a mortgage they don't have. Not a typo, not a scam, not one of those buy real estate with no money down YouTube ads that's secretly selling you a $2,000 course. I made this up. I've been using it with real clients in Northern Virginia and Southern Maryland, and it's quietly one of the most effective ways I've found to help someone go from "I'll never afford a house" to actually closing on one. I call it the mock mortgage method. And by the end of this video, you're either going to think I'm a genius or you're going to think I need a hobby. Possibly both, so let's get into it. If you're new here, hey, I'm Arthur Stewart. I'm a realtor with Sampson Properties, licensed in Virginia and Maryland. And I spend my life buried in Stafford, Prince William, Fairfax, Loudoun, Fauquier, and Southern Maryland real estate markets. This channel is where I translate what actually happens in this market into stuff you can use without the fluff. Before I dive in, a few weeks ago I put out a video called 10 Buyer Hacks. And honestly, hack number 3 and hack number 7 alone have saved my clients thousands of dollars at the closing table. If you haven't watched that one yet, there's a card right up there, and I'll bring it up again at the end, because today's video actually builds on one of those ideas from the list. But this one's a full method. It gets its own video. So subscribe if you're new, because I put these out regularly. And let's talk about the affordability problem, because that's really where this starts. Here's where we are right now, and I'm not going to sugarcoat it. Mortgage rates are sitting around 6.67% to 6.69% as of this month. Freddie Mac put out the numbers, and it's basically been parked there for weeks. Not the 8% horror show from a couple years back, but nowhere close to the 3% fantasy land everybody still has stuck in their head from 2021. If you're waiting for that to come back, respectfully, stop waiting. Start planning instead. Meanwhile, home prices in the regions have not gotten the memo that affordability is a problem. Loudoun County's median sales price is up 7% year over year. Fairfax is still sitting around $750,000 for an average sales price. Even Fauquier, which people think as an affordable option out there, is pushing into the 600s to 650 range. And homes out there can actually sit longer on the market, which is its own weird twist, but we'll get to that later. And here's the part that makes it personal instead of just statistics. I have clients, smart people, good jobs, some of them literally work for the federal government or a contractor supporting it, who are watching their rent go up every single year. And every year the gap between what they pay in rent and what they need to pay for mortgage gets even wider. Not because they're bad with money, because the math genuinely got harder. The math's not mathing. So a couple years ago, I started to ask a different question. Instead of, how do we get the price down, which, spoiler, I don't control, I started asking, how do we get you ready for the payment that's coming before it actually shows up? That question turned into the mock mortgage method. Okay, here's the actual concept. It's deceptively simple, almost annoyingly simple. You're going to hear this and go, that's it? Just wait, because the simple version is not the whole method. I'll get to why in a minute. The idea, if you're currently renting for, let's say, $1,800 a month, but the home you actually want will put you at a $2,500 monthly payment. You don't wait until you buy the house to start living at that payment level. You start now. You pretend the mortgage already exists. You pay it every single month, starting from today, even though the house isn't yours yet. Practically, that means you keep paying your actual rent of $1,800, but you also set aside that extra $700 difference every month into a separate account. Where exactly that account lives matters more than you'd think, and I'll get to that in a minute. You are, in effect, rehearsing the financial pressure of homeownership before you lock into a 30-year contract for it. Think of it like this, and stay with me because this is going to sound like a stretch, and then it's really going to click. Nobody runs a marathon by showing up on race day, never having jogged before. You train at the race pace before the race happens. So your body already knows what it feels like. This is the same thing, except instead of your knees finding out the hard way, it's your bank account. 3 things happen when you do this. Thing 1, you build real cash. That $700 a month becomes $8,400 over the year. That's a meaningful chunk toward a down payment or closing costs, sitting in an account. completely separate from your regular life. Thing two, and this is honestly the more important one, you find out whether you can actually survive at that payment before contractually obligating to it. If month two rolls around and you can't make the mock payment without going into your emergency fund or racking up credit card debt, that's not a failure. That's valuable information. That's the market telling you gently before your lender tells you the hard way. Thing three, and this is one almost nobody thinks about until I say it out loud. What if the rates drop? What if prices soften a little? Which honestly is already starting to happen in the condo and townhome segment across Northern Virginia and Southern Maryland. Are you going to be ready to move the second the math finally starts to work in your favor? Are you going to be the person who is still not ready? Still scrambling to pull a down payment together, while somebody who's already been quietly doing this for a year swoops in on the exact house you wanted? Sit with that for a second, because here's the honest truth. Even if none of the other benefits mattered, even if you never once dipped into it, even if rates and prices stayed exactly where they are forever, you would still come out ahead. If nothing else, you're preparing yourself for the moment the market shifts in your favor, instead of finding out about it 3 weeks too late. That's the core idea. Now, here's where most of the people who try to DIY this get it wrong. And this is the part that actually makes it work. The 5 things everyone gets wrong. Number 1, your mock payment needs to be the whole payment, not just part of it. The mortgage industry loves acronyms. PITI, that's principal, interest, taxes, and insurance. If you have less than 10 to 20% down, tack on PMI mortgage insurance as well. And if your home has an HOA or a condo fee, that's another line item. Here's why this matters right now. Specifically, the inventory that's opening up across Northern Virginia and Southern Maryland this year is heavily weighted towards condos and attached homes. NVAR's July numbers show condo inventory up 40% year over year, while detached single-family homes actually went down. So more of the buyers are looking for properties with HOA dues attached, sometimes $200, $300, $400 a month. If you mock a $2,500 payment, but the number was just principal and interest, and the real number or the real payment turns out to be $2,800 once you add the taxes and insurance and the condo fee, you've trained for the wrong race. You showed up on move-in day and got hit with a $300 bill you didn't budget for. So step 1, get a real full PITI estimate. Your lender or I can run this in about 5 minutes before you set your mock number. Number 2, automate the delta in an account you can't see. I want to gently point out that I'll just save the difference myself is the diet plan of personal financial failure. We've all said that. I'll just eat better right before we order a pizza at 9 p.m. because willpower is a finite resource. This has 2 parts, and most people only do half of it. First, set up an automatic transfer for the day your rent is due. Same day, every month, no thinking involved. If it requires you to make an active decision every month, you will eventually skip a month, and then skip 2 months. And then you're back to square one and wondering why your account isn't growing. Second, and this is the part people skip, send that money to a high-yield online savings account. Not the little savings tab sitting right there in your everyday banking app, one click from your checking account. A completely separate, online-only bank, out of sight every single time you check your balance. It also happens to earn a better interest rate just for sitting there, which is a nice bonus. But the real point is psychological. If that money is staring back at you every time you open your app, you will borrow from it for a nice dinner and call it a loan you'll pay back, which we all know most likely you won't. Number 3, this is not your emergency fund. Keep them separate. Picture this, you've been doing great. 6 months in, mock account's looking healthy, and then your card makes that sound. You know that sound, the "this is going to cost you" sound. If your house fund and your emergency fund are the same pile of money, that repair just quietly ate 3 months of progress, and you didn't even clock it as a setback. You just sort of absorbed it. 2 separate accounts. Boring advice, I know, but boring advice is usually advice that actually works. Number 4, keep a paper trail. This actually matters for your loan later. This one surprises people. When you eventually apply for your real mortgage, and underwriting is going to look at your bank statements, and they specifically look for large unexplained deposits. If your mock mortgage account suddenly shows a random $8,000 deposit right before you apply, that could actually slow down your approval while you dig up some documentation to explain where it came from. The fix is almost funny in how simple it is. The same consistent automated payment, clearly labeled, the monthly transfer we talked about in tip 2, also solves this problem. Lenders love seeing a steady, documented savings pattern. It's basically financial proof of discipline, and it can genuinely work in your favor during underwriting. Number 5, run it in a 90-day sprint. Not the next 30 years starting now. Here's the mistake people make when they try to do this on their own. They mentally commit to doing it forever, get overwhelmed by that, and quit by month 2. Don't commit to forever. Commit to 90 days. One sprint. That's it. At the end of those 90 days, check in with yourself and be honest. Did every transfer actually happen? Did you dip into it once, twice? That's not a moral failure. That's just data. It tells you whether your number is realistic or whether it needs adjusting. And while you're checking in anyway, use the same 90-day mark to recheck the market. Rates move. They're hovering right now at 6.67%, but that can shift. If you set your mark payment in sprint 1 and you're still using the same number 3 sprints later without checking back in, you could show up to the actual purchase undersaved for what the payment really is now. Then decide, run another 90-day sprint, adjust the number, or if you've been doing great, go sit down with a lender for real. 90 days at a time. That's what makes this sustainable instead of one more thing you feel guilty about by March. You can do it. It's just 90 days. And look, I get it. This might sound great on paper, and you're probably wondering if anyone's actually stuck with it long enough for it to matter. That's a fair question. I have clients who have had a mock mortgage, and if you ask any of them today, every single one of them will tell you the exact thing. It was completely worth it. I have never had a client tell me they regretted starting early. I've even had clients who have continued their mock payment even after they bought their home. All right, so how do you actually do this starting today? Not someday. Step 1, figure out your real target payment, not a guess, an actual PITI number for the kind of home and area you're looking at. This is genuinely a 5-minute conversation with a lender, or honestly, you can just message me and I'll run it for you. Step 2, open a high-yield online savings account, a completely separate bank from the one you use every day, so this money is out of your view and out of temptation's reach, and it earns real interest while it waits. Step 3, automate the transfer for the same day your rent hits. And here's the part I really need you to hear. Pay this account first, not last, not whatever's left over at the end of the month, first. Same as rent, same as your car payment. If you wait to see what's left over before deciding whether you can afford the transfer, the answer will mysteriously always be not much or not enough. Pay yourself the mock mortgage before you pay for anything fun every single time. Step 4, commit to a 90-day sprint. Not forever, not the rest of your life, just 90 days. Put a reminder on your calendar for day 90 to check in with yourself. That's it. That's the whole setup. 15 minutes of work, and you're already living like a homeowner before you technically are one. And listen, if you can't cover the entire delta right now, that's genuinely okay. Your number doesn't have to be $700. Maybe right now it's realistically $200. Maybe it's $50. It genuinely doesn't matter. You have to start somewhere. And I promise you, the money will come. I've watched it happen over and over. A raise shows up. A side gig kicks in. Some expense you thought was permanent quietly goes away. And if that $50 turns into $150, then $400 is on its way. $50 automated every month for a year is still $600 sitting in an account that didn't exist before. Perfect is not required here. Starting is. And look, I know somebody in the comments is going to say, Arthur, I don't have $700 a month. Where am I supposed to find that? Totally fair question. And it's exactly why I made that other video. Hack number 3 in my 10 buyer hacks video is specifically about finding money you didn't know you had in your monthly budget without feeling like you're depriving yourself of everything fun. Pair that video with this method and you've basically got a full playbook. Okay, before I let you go, quick gut check on what's actually happening in our market right now, because this method only matters if you understand the market you're trying to buy into. Northern Virginia and Southern Maryland overall inventory is up 20% from last year, but it's lopsided. Condos and townhouses are flooding back onto the market. Detached single-family homes are still tight. If a detached home is in your goal, expect more competition, not less. Loudoun County prices still climbing over 7% year over year, even though sales volume is roughly flat. Prince William, steady momentum. Inventory actually hit a 5-year high this year, which is genuinely good news if you've been priced out before. Stafford, still one of the more approachable price points in the region, especially if you're commuting towards Quantico or down the I-95 corridor. Fauquier, this is the one people sleep on. Prices are climbing there too, but homes can sit longer, meaning if you're patient and pre-positioned with your financing, you can actually negotiate. And yes, I have to mention that because it's real. Federal workforce changes have put some pressure on this region's economy. Here's the thing that actually surprised the economists who study this stuff. Demand held up anyway. People still want to live here. Schools, job market, quality of life. It's outweighing the uncertainty for most buyers, which honestly is exactly where getting yourself financially ready now before you compete for the right home matters more than ever. Okay, let's bring it home. The mock mortgage method in one sentence: start paying the mortgage payment you actually need before the house is real, so the money and your budget are both ready when the right home shows up. Full PITI, automated on a high-yield online account you can't see. Keep it separate from your emergency fund. Keep the paper trail clean. Run it in 90-day sprints. And if that number feels big right now, I promise you, it felt big to every one of my clients on day one too. You have to start somewhere. 90 days from now, future you is going to be really glad present you didn't wait around for the perfect moment to begin. And remember, rates can drop. Prices could soften. Nobody knows exactly when, but when that moment finally comes, you want to be the one who's ready, not the one who's just finding out. If this was useful, do me a favor and hit the like button. It genuinely helps this video reach other people in this market who are stuck on the same "how can I afford this" question you might have been 5 minutes ago. Subscribe if you want more of this. No fluff, straight from someone who's in this market every single day. And if you haven't already, go watch 10 buyer hacks right after this one. It's linked right here. And between the video and the method, you genuinely got more of a real plan than most people who walk into a lender's office cold. I'm Arthur Stewart, and I'll see you on the next one.